Hello everyone, in today's video we're going to talk about collecting passive income, owning real estate without having to manage real estate. If you're a busy professional, you're a Canadian DIY investor who loves learning about collecting passive income, then you definitely want to watch today's video because we're going to talk about how this works, private money lending, what accounts work with it, how much passive income you could potentially collect through your registered accounts, through your TFSA, through your LIRA. We're going to go into all that. I'm going to talk to an expert in this. CEO of Streetwise Mortgages is Dalia, and she's going to talk about the due diligence process.
Hey, Dalia. Welcome back to Financial Nirvana Mama Show. So, we have a very cool topic today about collecting passive income through properties, but without having to manage properties. So, want to
Right.
hear all about it. Your new arm, which is the private lending arm. Can you tell me more about this?
Yes. So private lending is a way to earn passive income, like you said, by investing in real estate without really being a landlord. So essentially, you're lending your money secured by a property, similar to being a bank. And by doing so, you're earning interest on that money. And eventually, you get that capital paid back once that borrower or owner of the property no longer needs it or finishes the project that they use the money.
So it just sounds like you're becoming a mini bank. And then who would want this type of money? Are you the ones making that connection? In the experience I have, like I would have to find someone, I'd have to do the due diligence and meaning check the credentials of the person I'm lending money to. So that's so much work. Forget it. Right. So tell me more.
Yes, it is so much work, but we do all of the work on your behalf. So let's say you have a $50,000 and you're interested in lending it privately. So we do have clients who want to use private money to grow their wealth in real estate, believe it or not. Some clients may think, who would use private money to grow wealth in real estate? But there are actually a lot of clients who do. I'll give you an example. Some clients use it, for example, to help buy a property that may be run down that a bank wouldn't fund, or renovate a property that a bank wouldn't fund, or as a stepping stone. They need to close fast on a deal and the traditional banks can't move fast enough. There are many reasons that are good reasons to why clients use private money. So we come across these clients and then we'll come to you, Tracy, and say, hey, here's a client. We'll do the homework. We'll show you, we'll do the homework on the property. We'll do the homework on the borrower. We'll do the homework on the market. And then we will analyze or make sure that you get your money back because we look at what's called exit strategy. So we do that homework on your behalf as a lender. You don't have to do it yourself. And that's part of our role as a broker, facilitating private money.
Right. So you're not just a connector, you're actually doing the due
So,
diligence.
yes, yes. And under the regulations, we have to also disclose to you any risks involved in a deal and make sure that when we bring a deal to you, you're comfortable taking these risks. For example, some clients may be comfortable lending that $50,000 in what's called second position behind another lender and make a higher return, 12, 13, 14%. Some investors may not. They may say, you know what? I want to be in first position and make less money, but that is where my comfort level is. So it's our role to understand what you're comfortable with and connect you with a borrower who can utilize that money where you make a decent return and we help with the diligence and everything.
Just taking a step back, but first position, second position. So you're like basically lending out the first mortgage, right? You could get a first mortgage or a second mortgage. So first mortgage would be like what, 75% loan to value? Like what would be the
Oh,
loan to value?
yeah. I wouldn't go above 80%
Good,
maximum,
good.
80% the maximum. I know that there are opportunities in the market to lend at a higher loan to value, but we're not comfortable putting our lenders in that position. So 80% is the maximum. And yes, it's a first mortgage and you would be looking anywhere. I mean, every deal is different, but to give you a range, 8 to 10% in terms of monthly interest. And then you make something called a lender fee, which is a bonus fee that you make in closing of about 1 or 2%. So on $50,000, take that 8%, multiplied by the 50,000, divided by 12, that's your monthly. And then on closing, you get that 1%, which is the 1% of the $50,000. You get it in cash as a bonus. So
Oh,
that's,
so that's awesome. Awesome. So you're getting basically a monthly distribution, like
yes, you get
super passive.
yes, you get a monthly interest payment for the duration of the term. And the terms can range anywhere from 3 months, 6 months, 12
Ooh,
months.
awesome. I like the short.
Like,
Perfect. Because sometimes you get locked in for years and you're like, when am I going to get my money back?
not private money is really a stepping stone. They're not meant to be long-term mortgages. And part of what we do is also look upfront at how the client who's borrowing money is going to be able to pay this money back. That's part of the work we do on exit strategy. You also asked me about second mortgages. A second mortgage, similar idea. We also go maximum up to 80%, but it's behind another lender who is holding the first mortgage. And you're earning 12 to 15% interest every month, in addition to that 1 or 2% lender fee that you get upon closing.
That's pretty cool because it's
Yeah.
like basically doing nothing and you could be collecting just literally income every single month on interest, 13-ish, 14% on a second mortgage, and then plus the whatever that fee that you collect at the end. Okay, so let's talk about what accounts work. Like how do you do that?
Well, you can lend through multiple vehicles. You can lend in cash. You can lend using registered funds. You can actually lend through your RSPs, RESPs, RIFs, LIFs, LIRAs. And what that means is you're not liquidating anything. The only difference here is that instead of your registered money, let's say holding onto stocks or bonds or some sort of a mutual fund, you're just directing where the money's invested. It's still within the umbrella of registered funds, but it's holding onto a mortgage. So that interest that we talked about goes into the registered account tax free.
Ooh.
Yeah. So you can lend in cash, you can lend through registered money, you could combine both. If you're lending in cash, you get that interest every month and you will get taxed at the tax bracket for interest income. But if you're lending registered, you're shielding that return and it's growing tax free.
So, okay, so just as a hypothetical scenario, you have $100,000 in your TFSA. You're like, I want exposure to real estate and you want to be comfortable with the asset that you're owning. Like, so you would basically could connect the TFSA to loan the money out and you become a bank instead of like this person who's actually needing the money goes to Royal Bank, you become Royal Bank basically. And you're like, hey, I'm going to lend the money out as a second mortgage on this one specific property. So for someone who wants to do that, would they know about the property? Like, well, how much information is shared with the person who's actually lending this out? Because the bank would get all the information.
First of all, if you were to lend using registered money, there is a process around how to go about it and how you set that up, okay, and without liquidating the registered. When it comes to securing your money against a deal, of course, it's all about the disclosure and transparency. So when it comes to the property, Tracy, I want to make sure that the value is there. So I get the opinion of a third party appraisal company and we share the appraisal report with you. So you see what that property is all about. You see its condition. You see how long it's going to sit on the market in case, you want to sell it. God forbid something goes wrong because there's always a risk. The borrower will share with you their story. We'll want to make sure they don't owe taxes to CRA. We do that diligence and share it with you. Exit strategy will let you know how they're going to exit the deal. And finally, the market itself, you can learn about from the appraisal report as well, because the appraisers talk about, is this market increasing, decreasing, is it flat? If you are to sell on this market, how long the stock is going to sit there. So everything is shared with you as a lender, and we guide you through the process and we help you understand also the risk, as I mentioned.
Worst case scenario, your first position on the mortgage and the person who needs the money goes into trouble, you basically can own a property at the end of the day, right? And then you would have to like find a way to sell it. Would you have to do that work or would you facilitate all that?
we make it really simple for lenders to get paid every month. And if something goes wrong, they have professionals by their side to help them tackle collections, if there are collections or they need to take over the property. So they don't have to figure it out on their own. So we work with reputable mortgage administrators, or what they're called. And their job is to take money from the borrower's account, put it into the lender's account every month, give you statements from your accountant, tell you how much interest you earned so you don't have to go through Excel spreadsheets. If you have questions, you call them or you call us. If there is a delay in payment for whatever reason, they tackle it based on the contract. And if the worst case scenario happens where, someone for whatever reason, they cannot pay you back and you need to take over the property and sell it, the administrators facilitate that with the lawyers.
In my experience, having to deal with this in the past is just like a lot of work. And you've done all the due diligence and you're connecting with the right people who you trust. And it's below 80% loan to value, which is like amazing because sometimes you do hear pretty sketchy. It could go to 95% loan to value, which adds a lot of risk to the people who are lending the money.
Absolutely. I mean, I am a big believer in risk management and protecting everyone's interest in the deal. Some clients want to go out and borrow at 90% and borrow even higher than 90%. Some lenders are willing to give them that money, but we don't do it. And I am highly against it because it is high risk for both parties.
For the viewers, when we mean like loan to value, we're talking about if a property is worth, say, $1 million, typically banks would try to only loan 80% of the value of the property because sometimes the market fluctuates. It's not always worth a million. So you only get loaned out $800,000. So that is 80% loan to value. So, anyways, just to clarify that point. But this is very exciting. I'm so happy that you're opening this new branch in Streetwise Mortgages. So, where can people find you to get more information about this?
There is a lot of content about how we lend and education around the risks and how we manage it on our website on streetwisemortgages.com under private money. But if you are interested in having a conversation about lending money, get more details about it, you can just email us at info@streetwisemortgages.com and request to speak with a private mortgage relationship manager, and they'll jump on the phone with you and help you understand all of this. If you want to become a lender with us, then you have to go through the process of, discussing your goals, your risk appetite, the type of deals you're comfortable with. And then we can handhold you and show you some deals eventually to help
Oh,
you.
that's awesome. Awesome. That's great, Dalia. I'm so glad to hear you. You also like assess the person who's lending, who's willing to lend, like if it's appropriate for their financial goals, right? Because
100%. Yeah, it's called suitability.
suitability. And that's because you actually have a significant banking experience, like 20 years. You're talking like a banker.
That's what I learned in the banks, and I am grateful for that because it does get me to see things with risk, in mind.
It's all about risk management and
Yeah.
calculated risk taking.
Yeah, it's not just about the double digit returns. And I actually have an article that talks about beyond the double digits return because risk is a part of it, right? Like you said.
Yes. Awesome. Okay. Well, thank you so much. This is wonderful.